Welcome to Biotechonomics TV. Today we're going to talk about 2020 venture capital raised and invested in the biotech industry. I'm going to look at it by metro area. So overall, we had $24 billion invested across the biotech industry, across 667 deals. Now the methodology I use counts bio-related ag investments like agricultural genomics and other sorts of ag tech, includes medical devices, does not include digital health or software. So 84% of that 24 billion was raised in the top 6 markets. And I'm going to go into what those markets were in just a bit. The other interesting number, about 19 billion, was raised in the IPO and SPAC markets. Now I'm going to talk about those in a future video, but it's just a good comparison to see we raised just a little more money through venture capital than through IPOs and SPACs. So as I mentioned, 84% was raised in the top 6 markets, 74% in the top 3 markets, which not surprisingly were Boston, the Bay Area, and San Diego. Now, one of the things that drove the higher levels of investment in the larger markets was larger average deal sizes. So you can see here in Boston, the Bay Area, San Diego, we had an average deal size of approximately $50 million. When we get to that second grouping, New York, LA, Philly, the average deal size dropped to about $25 million. And then beyond the top 6, we start to getting into the university markets like Boulder, like New Haven, like Madison, or some of the large markets that are big overall but not so big for biotech, like Chicago, Dallas, Houston. You start to see deals averaging about $17 million. Now, one of the reasons this is occurring is because the venture funds, the large venture funds, are primarily in Boston, New York, and the Bay Area, and they tend to invest locally. So what we see in these markets, and as well as the investments that are going into San Diego and to some extent LA, is a lot of the investment is coming from venture capitalists. Whereas if we look at these other markets, especially the university markets and those that are really outside of that top 6, you see a lot of investment from crossover funds. Now, a crossover fund is a fund that invests both in private equity as well as public markets, public stocks. And that is where a lot of the capital is coming from outside of the traditional biotech markets. So one of the interesting things that's happening in these larger markets is the venture funds themselves are getting a lot larger. The average venture fund now that's investing in biotech is getting larger and larger, an increasing number of over $500 million and heading towards $1 billion. Let's use an example here from Andreessen Horowitz. Andreessen Horowitz started investing in biotech in 2015 with their Biofund 1. That was a $200 million fund. And they came out with Biofund 2 in 2017. That was a $450 million fund. And then towards the end of last year, they announced Biofund 3, a $750 million fund. So not only are the large markets doing bigger deals, getting more deals, the venture investors who are investing in those markets are also raising larger and larger deals. So that, if anything, is going to reinforce their leads. Now, other markets could come in and continue to grow, but actually taking share is going to be a bit challenging. Before I talk about that a little more, there's a related issue, and that's lab space. Now, one of the interesting things that we see here is that some of the second tier, third tier markets are actually building more lab space per venture dollar invested. So what that means is, of course, is that the larger markets are getting more expensive. And CBRE put out some numbers that showed Kendall Square lab space now leasing at over $100 a square foot. So you might be thinking, well, wouldn't that push people or push companies out to other markets? And we don't really see that happening, actually. I think given the fact that biotech tends to be very heavy on just investing in research as opposed to hiring a lot of people, and really getting drugs out into the clinic, there doesn't seem to be that much cost sensitivity, or as much as you might expect, in lab space. As economists would say, it's fairly inelastic. So interestingly, Raleigh-Durham, which is building tons of lab space, actually some of the cheapest rates and also some of the highest vacancy rates for lab space, whereas in Boston and the Bay Area continues to be a struggle to find lab space. One thing I'm seeing in the Bay Area is conversions of office space. So one of the things that's keeping the Bay Area actually a little cheaper than Kendall Square in Cambridge is the fact that a lot of traditional offices are converting over to lab space, especially in the Mission Bay neighborhoods and South of Market neighborhoods. So even the low-cost lab space isn't really enough to lure biotech companies. Another thing that's not really luring them are tax incentives. You hear a lot of news about everyone in California is supposed to be moving to Texas, and maybe that's true for Elon Musk, and maybe it's true for some established companies. Certainly not the case in biotech. You need a lot more then an economic incentive to really start gaining a lot of new biotech startups. So we continue to see California, New York, Massachusetts accounting for over 80% of all deals just in those 3 states. And there's really not a trend to suggest that that's going to change significantly over the next year, 2, even 3 years. So just to wrap up, I think we want to look at, well, what markets out there could possibly take share. I think if there's one that's really interesting, it's probably New York, which is hanging around number 4, could start to overtake San Diego a bit. And I think that's simply because of the availability of capital. Another interesting market is Connecticut. Now, if you go further out into Connecticut around New Haven, we saw Rally Bio do a $145 million deal. Again, that was mostly with New York and Boston money. But as you get closer in Fairfield County, Stamford, Greenwich, there's actually quite a bit of capital there. A lot of the VC funds have second offices there. I think that could actually turn into an interesting market. So those will be interesting markets to watch. What I don't see and where we don't see a lot of movement is in the middle of the country. Chicago has a little bit of activity. Obviously Arch has an office there, Arch Venture Partners. But for the most part, we don't see too much happening in the middle of the country. The long trend of biotech being centered, California, a little bit of Seattle, Northeast Corridor, Raleigh, Durham, is pretty much staying where it is, even as the industry experiences significant growth. That's it for today. We'll talk to you next time. We'll do another video on IPOs and SPAC funding that should be out in, say, a week or 2. Please subscribe, and we'll talk to you next time.